Alrighty, now the market's in crisis, according to the talking heads. But let's take a look at some key levels here and let's walk through and understand where the importance is of where markets are right now. If we're going to see a buy the dip or are we going to see a sell the rip? So let's take a look here at the S&P 500. So today we got to bounce off this moving average here, which is the 50-day moving average. If we back this out a little bit here, you can see that the 200-day is significantly lower, and we have a lot of room to go if we get back to that 200-day moving average. So we're just talking about the S&P 500. This is the broad indices, 500 companies. It's the easiest to cover, but we did we did bounce off this level here. It's another key level as well. In other videos, I often talk about expected move. Expected move is what's priced into the marketplace. It's an expected move in a stock, expected move in the indices, and we'll take a look here at the expected move from last week going into this week in the SPX. So what we take a look at is this is on Friday. This is Friday's close, and we're looking at this following Friday's expected move. So 7 days to expire at that time. So two non-trading days and 5 trading days. So we take that and we look and we see that there is a $73 priced in move. We come back to the chart here, and where did we hold? We held right in that level there. So this is a priced in move here. Right here, the systems, banks, auto hedging systems on the big banks are buying at these levels. They're hedging at these levels, and so we're holding this level here. It's a key level. We could see prices roll over if we get below here, and that's where things get really interesting. We can see a pretty significant more selling step in because those systems now have to go opposite of those trades and sell into the hole and push prices lower here. So that's why it's a pretty key level of where we're at right here. But we could see at this point, my point is we're seeing where markets were priced in already. This is already expected. A 1.5% move sell off in 1 day is really nothing at this point where we're seeing where markets are at all-time highs. If we had a 5% move in 1 day, I would say that's pretty significant. So on days like this, what I do and what most successful traders are doing is they're not trying to trade this move. You have positions already on that are hedges in certain situations if you have a system, and you unwind those. You unwind those because we're in the key level here. So we unwind them, and then if your system is still long only, because we're still in a bullish market, it's bullish volatile, but we're still in a bullish market here. So that hasn't changed. The market's still going. The trend is still higher at this point. We haven't seen a change in direction. There are some important aspects that have happened. Energy got hit today. Banks got hit today as well, and banks, energy, airlines, all those energy are what brought the market lower here. So those are key points to look at. Let me show you the VIX here, which is the volatility index on the S&P 500 here. So we got a spike higher here, and this is what we typically see in the VIX. We're just taking a year time frame. You see a spike, comes back in, spike, comes back in. That's how volatility is, it spikes. So on days like this, it's really important, especially when you're trading options, not to kind of jump out there and look to put on trades. If you're trying to sell options, a little bit more advantageous, but you got to pick your spots as well. Just selling options because volatility is high is not a successful approach. You got to be strategic. Everything comes down to strategy. But on days like this, you want to be more of a seller of an option than to be a buyer. If you're buying, you have to hedge it with something else because you have that volatility that's going to come in. And right now, premiums are higher. Once that volatility comes in, that premium, the option that you paid before, is much lower, and that's where significant losses come. So, oftentimes people say, well, Josh, I'm going to buy the dip here. I'm going to buy a call. Well, that's not the best way because even the prices go higher, the volatility goes lower here. You're not going to make money. It's a very tough way to make money. It'd just be better if that's the case, just to buy stock. That's where options can get messy. But understanding that on days like this, put your hands in your pocket, you don't do anything. Put your hands under you can sit on your hands as well. Whatever you do, there's not much you should be doing. For me, I have a couple positions that I closed out of that were bearish because I got the move that I wanted. So now I look for setups, create a watch list, and move on from there. So we looked at the VIX here. We looked at, let's take a look here at the VX futures. So the VIX is a cash settled, VX are the futures here. An interesting thing to keep an eye out for as well is what we're seeing here is what's known as forwardation, forward and out. Typically, we see backwardation in the futures contract because the present fear or the present uncertainties right now compared to further out. So what we're seeing here is right now we're 2 days to expiration in July. Don't really pay too much attention to that. What we're seeing here though is we're starting to see that fear pick up in the back month here. And on the August contract, it was last priced at 23.12. The September, which is kind of interesting, is at 23.25. So September is a little bit higher than it is on the August. That's interesting. We're starting to see volatility kind of perk up in that back, indicating that September could be a more volatile month at this point. I mean, that could change tomorrow. But right now we have 2 days to go on the July contract. August then comes into play. We have earnings season coming in, so that's why volatility would be a little bit higher. And you would see that typically, but we're not seeing that. We're seeing the volatility more in the September contract or the September term, which is interesting. Not too much. It's interesting. It's not significant enough to be, that this is an alarm. It's just interesting, and it's an interesting way to keep an eye on the marketplace to understand what's going on here. So right now, key level on the S&P 500 specifically, we look at the Qs as well. The Qs didn't really do anything today. They sold off and then found buyers, and the expected move on this one on the Qs was $7. It's exactly where buyers came in, the systems came in, bought off that. So these are important levels. This is already priced into the marketplace. Now, if we see a move below here, that's where things get interesting. That's where that program selling will come in. More fear will come into the marketplace. That's where things can get a little bit more shaky. So we're at key levels here. No matter what CNBC says, market's in turmoil. We're not even there yet. We're far from there. We have a significant amount of selling that would have to happen for markets to be in turmoil. So that's what I have for you today. Again, ignore the noise, follow the signals, and keep focused. So make sure you leave a comment below. Let me know what you think. Like the video with a thumbs up, share it, and subscribe. We'll see you in the next one.